Good day, and welcome to all legal practitioners and stakeholders to this LPC awareness session. The purpose of this awareness session is to facilitate open dialogue between the Legal Practice Council, the legal practitioners, on matters relating to regulation of this legal profession. As we pick up on major issues while we are conducting our regulatory work, we seem it prudent to conduct awareness sessions to share information that is useful for practitioners to ensure compliance with the Legal Practice Act, the rules, the code of conduct, as well as the regulations. Before we begin this session, allow me to discuss some house rules. Due to the high number of participants that we have, we kindly request that you type your comments and questions in the Q&A column of this webinar. The presenter will deal with these questions at the end of the sessions. If there's any other general query or suggestions that you would like to make, we suggest that or future ideas for the webinars, we kindly request that you send us an email at info@lpc.org.za. The recording of this webinar will be available next week. It will be available on our YouTube channels. Kindly follow us on YouTube, Facebook, and on X. You are also reminded that the LPC offers the services of the library service, and this will assist you as legal practitioners in conducting research and also preparing for matters that you will have in court. In order to be assisted with the library service material, you can send an email to helpdesk@lpc.org.za. You are also reminded as legal practitioners to ensure that you are in good standing with the Legal Practice Council by ensuring that your annual fees are up to date and paid. This ensures us as the regulator to continue in doing our job to protect the legal profession, protect members of the public. Lastly, we would like to remind all legal practitioners who are eligible to have a Fidelity Fund certificate that the portal is currently open and that you are able to apply for your 2025 Fidelity Fund certificate. Should you have any issues with the Fidelity Fund certificate, we kindly request that you contact your provincial office. They will gladly assist you in obtaining your 2025 Fidelity Fund certificate. I would now like to hand over to our next speaker, that is Mr. Ashwin Reddy, to deliver his presentation on trust accounts. Thank you. Mr. Reddy?
Thank you, Margaret, and good afternoon, colleagues. My name is Ashwin Reddy. I'm the National Manager of Audits and Curators in the LPC. During my time at the LPC, I've conducted numerous inspections of attorney practices, and I'd like to share some of my experience with you today. I'm just going to switch off my camera for those with the low bandwidth, and we're going to get started. So oftentimes when we look at practitioners who have become suspended or struck from their role, we can, in most cases, trace this back to there being a poor management of trust monies. There seems to be a mindset among some practitioners that the management of trust monies and the accounting of trust monies is merely a compliance function, and it's something that they perform in August or at the end of their financial year in order to simply provide the LPC with an audit report and to obtain a Fidelity Fund certificate the following year. This mindset, I think, amongst practitioners needs to change. The management of trust monies is a critical component to the success of a legal practice. So if we are to consider why there's a need for the proper management of trust monies, Firstly, it is compliance with the regulatory framework, that being the Legal Practice Act, the South African Legal Practice Council rules, as well as the Code of Conduct. Secondly, and most importantly, clients are placing their trust in legal practitioners. There's thus a duty to effectively manage and account for trust monies. And three, as I indicated previously, it's essential for the long-term sustainability of a practice. If you cannot properly account to your clients and you do not pay them monies that are due to them on time, that practice cannot sustain itself in the long run. Then the consequences of poor management of trust monies is, firstly, there will ultimately be a breakdown in the attorney-client relationship. This is predominantly due to the non-accounting or non-payment of trust monies. Two is the possible loss of trust monies due to there not being no safeguarding of monies held in trust. Three is something that we see quite regularly. There's incorrect fee transfers. Oftentimes, attorneys aren't aware of the fee that's actually due to them, so they merely transfer their fees in tranches, and it's usually in round amounts of 20,000 or 30,000 Rand at the time. And it's simply because they don't know how much monies are available for a particular trust creditor, and they haven't yet quantified the fees that's actually due to them. Then the next consequence could be audit qualifications, which leads to delays in obtaining or the approval of the audit reports by the RPC, which ultimately have an impact on their Fidelity Fund certificate. And lastly, in more serious instances, it can ultimately result in a practitioner's suspension or being struck from the role. If we are to consider the pillars of proper management of trust monies, it would comprise of trust accounting on the one hand and safeguarding of trust monies on the other. If we speak of trust accounting, it would comprise three components. Firstly would be the accounting system, and an accounting system can be computerized or it can be a manual book of entry. And this is ultimately the discretion of the practitioner. So you could choose to utilize software such as LexPro, Legal Suite, AJS, Sage, Zero. But ultimately, it's a legal practitioner's discretion. He or she needs to undertake a needs analysis and find a system that suits their particular needs. Then once an accounting system in place, there needs to be an input into the accounting system, and that needs to be in the form of either a bookkeeper or an accountant, and this can be in-house or it can be an outsourced service. Or if the firm is still relatively small and there aren't too many transactions, the service can be performed by the practitioner himself or herself. And then lastly, the records still need to be updated timelessly. So in terms of the rules, the accounting records need to be written up and balanced on a monthly basis. And then if we have to move on to the safeguarding of trust monies, the components for this would be, firstly, for a practitioner to have a valid Fidelity Fund certificate, for the legal practitioner to hold a trust bank account that's properly designated in terms of the Legal Practice Act. So this means that your accounts are either in terms of Section 86, 2, 3, and 4 of the Legal Practice Act. And lastly, that the practitioner has implemented internal controls to safeguard trust monies. The Legal Practice Act, in terms of Section 87, stipulates the responsibility of a legal practitioner to maintain proper accounting records. And this is in respect of monies received and paid on its own account, monies received, held, paid on account of any other person, monies invested in a trust account or other interest-bearing account referred to in Section 86, and any monies and any interest on money so invested, which is paid over or credited to it. And this section of the LPA is complemented by Rule 54.6 of the Legal Practice Council rules, which requires a firm to maintain accounting records for both the business and the trust account. In previous sessions, we've dealt with what constitute accounting records, but for the benefit of those who haven't attended previously, accounting records is any document or record which relates to cash trust monies, your Section 86, 2, 3, and 4 accounts, and any interest earned thereon, as well as any deceased estate, insolvent estate, or curatorship estate, where the legal practitioner acts in a capacity as either the executor, trustee, curator, or administrator. And accounting records would typically comprise of your trust cash book, your ledger, your trust trial balance or trust creditor listings, your annual financial statements, your bank accounts, both business and trust accounts, your liquidation and distribution accounts if you deal with deceased estate matters or insolvency matters, trust receipts, as well as proof of payments. And in terms of Rule 54.10, legal practitioners are required to update their trust accounting records on a monthly basis and also to have them balanced on a monthly basis. Rule 54.9 requires that legal practitioners retain the accounting records as well as client files for a period of at least 7 years from the date of last entry in each particular book, document, or record or file. Earlier, I mentioned that there needs to be a change in the mindset of a legal practitioner, and this slide deals with management control. So the expectation is that a legal practitioner should actually take ownership of their duty to maintain accurate and complete accounting records. And this is even in circumstances where they have delegated this duty to a bookkeeper or accountant or outsourced the service completely. And when a legal practitioner reviews accounting records, they need to ensure the following at a minimum, and that would be that the accounting records are updated and balanced timeously, that the records are accurate. This means that transactions have been posted to the correct trust ledger account, that the accounting records are complete. This means that all trust bank accounts have been taken into account and all transactions have been recorded. That there are no trust creditors with debit balances. If you have a trust creditor with a debit balance, it means that you have paid out more on a particular matter than you have received money, trust monies for that particular creditor. And then the next item that should be reviewed is if there are any unexplained journal entries between unrelated trust creditor accounts. This is something that an attorney needs to be cognizant of and would need further investigation. And lastly, and most importantly, the practitioner at all times needs to understand what the trust position is. So this is a comparison of the trust funds held in your trust accounts, either in 86, 2, 3, and 4, as compared to the firm's trust creditor liabilities. And this can be done by simply drawing a list of trust creditors from your accounting system or a trust trial balance and comparing it to the trust balances that you have on hand. And if the monies are insufficient to meet those liabilities, then you have a trust deficit, and such deficit needs to be reported to the Legal Practice Council. Legal Practitioners Fidelity Fund, their primary responsibility is to reimburse members of the public who have suffered a pecuniary loss as a result of the theft of any monies or property given in trust, by a legal practitioner or his staff. And the important part to consider in this is that the LPFF may elect not to entertain a claim arising if a practitioner's fidelity fund certificate has been withdrawn or is no longer valid, and if that information has been published for public verification on their portal or website. So it's thus imperative when we consider the safeguarding of trust monies that a legal practitioner is always in possession of a valid fidelity fund certificate. The duty to safeguard trust monies is not an ideal. It's actually contained in the rules for the legal profession in terms of Rule 54.14.7.1. There is a duty for legal practitioners to put in place internal controls that address the risk of misappropriation of trust funds. Internal controls should be adequate to address identified risks. Internal control should be implemented as designed. And lastly, the effectiveness of internal controls should be monitored throughout the period that they are implemented. So, as most of you are legal practitioners, the term internal controls may not be that familiar to you. So if we are to break down the concept, an internal control is basically policies, processes, tasks, behaviors, and other aspects of a firm that taken together enable the firm to respond to business, operational, financial, and compliance risks, and allow the firm to achieve its objectives. Internal controls also allow a firm to safeguard its trust assets and identify and ensure that liabilities are identified and managed. Internal controls also assist a firm in ensuring compliance with laws, regulations, and other internal policies. The internal control framework comprises of 5 components, which are your control environment, the risk assessment, control activities, information and communication, and lastly, monitoring. So we're now going to delve into each component in more detail. The control environment is essentially the foundation for all other components of internal control. And it sets the tone from the top of the firm as to how a firm is managed and governed. The following factors will make up your internal control environment. And it starts with your ethical values and integrity. And this is something that management at the top need to convey. So if management lacks integrity, it can trickle down into how employees behave, and it creates opportunities for fraud and corruption. The next element is human resources, policies, and procedures. In a legal practice, one of the biggest aspects that needs to be managed is your human resources. And this can be done effectively by ensuring that there are sound hiring procedures in place, training employees, and maintaining appropriate discipline. Third is the structure of the firm. There should be a clear organogram and understanding of the reporting lines. The fourth aspect is participation of those charged with governance. So, as I indicated previously, the directors and partners of a firm need to be actively involved in the design and monitoring of internal controls. And this is overlapped with the next item, which is management style. So, management needs to convey the importance of internal controls in its operating style so that all employees understand the importance of the matter. And lastly, there's responsibility assignment. And in a legal practice, there should be clear lines of accountability and responsibility. And there should also be an effective segregation of duties. The next component of the of the internal control framework is risk assessment. And if you are to effectively design a system of internal controls, it is necessary for you to perform a detailed risk assessment of your practice. And the risk assessment in a legal practice environment should consider the following factors at a minimum. Firstly, it's the legal structure of the practice. That is, whether the practice is in the form of a sole proprietorship, a partnership, or a personal liability company. So the legal form of the company or the firm has an impact on the firm's risk. So, for example, a sole proprietor has the unique risk of continuity issues in that if the practitioner passes away, there is no continuity and consideration needs to be given as to what happens to that practitioner's client files and trust monies if in the event a practitioner passes away. In the case of a partnership or a personal liability company where there is joint and several liability, this on its own poses a unique risk in that if you have a co-director who's at your same level, how do you manage and monitor that individual's transactions on the trust account? And these can be dealt with in the form of a shareholders agreement or any other agreement that governs the relationship between directors or between partners. The second factor to consider is the practice areas and the type of practice that you have give rise to unique risks which then need to be managed. So, for example, in conveyancing, it's more prevalent that there would be issues such as business email compromise, whereas in personal injury claim matters, you have a risk such as non-compliance with other pieces of legislation, such as the Contingency Fees Act. If you do criminal law work, you are maybe subject to a high risk of receiving trust cash, which then give rise to FICA compliance issues in that you may have cash transactions over the threshold, or alternatively, you would need to consider the source of the monies being paid to you. Third is the size of the firm. So this would include aspects such as the number of staff, the qualifications and experience of staff, as well as branches. So for a firm that has 100 staff members who operate in branches in 3 major cities, their risk is a lot different from a practitioner who operates out of a single office in Johannesburg, as an example. Fourth is the physical location of the firm. So if you are located in an area of town which is where the crime is slightly higher, then there's risks such as the theft of property from the firm's offices, which then need to be considered and managed. And lastly, something that's become more relevant in recent times is a firm's IT systems and software that it utilizes. So if all your information is stored on a cloud accounting or cloud server, that gives rise to unique risks in that there's a risk of cyber attacks. There's a risk of losing that data due to information being corrupted or otherwise lost. And as part of the risk assessment, it would be then incumbent on a practitioner to identify the risks that are specific to his or her particular firm, and then to implement internal controls that address these specific risks. The next component of your internal control framework is your control activities. And these are simply the policies and procedures that help ensure that management directives are carried out. So an example of a control activity in a legal practice include segregation of duties. This could be in circumstances where a staff member who requisitions a payment is not the same person who is responsible for authorizing payments. There could be the implementation of standard operating procedures. There could be approval and review processes. So, for example, if you have a payment process that is required where you need to make payment from a trust account, and there's various tiers and levels of authority with regards to that authorization, that would be regarded as a control activity. The next item would be a file audit. So if you have professional staff, and this is a useful tool to ensure compliance with the firm's policies and procedures. And lastly, you have access controls, and this can be logical access controls as well as physical access controls. Logical access controls are simply an example of it is a password on a computer, whereas a physical access control is, let's say you have a server that's located in an office and you need to have that office locked at all times, and the key remains with a responsible official of the firm. This component of the internal control framework is information and communication, and this component relates to the identification and transfer of pertinent information in a timely manner to allow personnel to carry out their responsibilities. And this can be an example where a legal practitioner has to submit his audit report to the LPC at the end of August. In order for that to happen, he needs to ensure that the relevant information is provided to his auditors to ensure that they are able to complete their work on time and that the LP is able to submit his report to the LPC within 6 months after his financial year end. And then lastly, there's monitoring. And this is a process that's ongoing, and it's a key element of management's responsibility. As a practitioner, it is ultimately their responsibility to ensure that controls are operating as intended and determining whether they are effective. And if controls are not operating effectively, then as a practitioner, it is your responsibility to then modify these controls to ensure that the risks are adequately addressed. If we look at issues that currently face legal practitioners and possibly place trust monies at risk, we have aspects such as phishing scams, and this is simply uh, communication that you receive via SMS or via email, where it seems to be from a legitimate source and requires you to click on a link. And once you click on that link, there is software that is installed onto your laptop or cell phone, which then um, either tracks your passwords or is able to um, allow your passwords on your online banking to be shared with the fraudster. And in this way, they are able to access your bank accounts and effect unauthorized payments from the trust account. The second aspect is business email compromise, and like I mentioned, this is quite prevalent in the conveyancing sector. And this is where your emails to your clients are intercepted. So to give you the example of a conveyancer, he or she would typically send their pro forma invoice to the purchaser via email. But what happens is the fraudster intercepts that email, changes the banking details on that pro forma invoice, and then forwards it on to the client. The client then receives an email which appears to be from a legitimate source and from the conveyancer that is attending to his transfer. He then effects payment in accordance with the banking details on that document, which has been modified. And in this way, monies are channeled into the fraudster's account. The next issue is fraud that is perpetrated by a practitioner's staff. This could be professional staff or even administrative staff, and it's usually involving a manipulation of the payment process. We often find instances where staff would falsify banking details on a payment requisition or when they load payments. And the usual explanation is that the client at a late stage then indicated that he wishes for his banking details to be changed. However, this information is not verified by the legal practitioner. So the legal practitioner goes through the supporting documents, but he's actually verifying the amount that needs to be paid to the client, but he hasn't actually considered whether the payment is being effected to the correct account. And in this manner, payments are being channeled into the fraudulent employees' bank accounts or bank accounts under their control. The fourth issue that is prevalent is for practitioners who receive trust cash. And this usually happens where we have a receptionist who is responsible for receipting cash payments at the office. And what happens is he or she receives 10,000 Rand as cash, but instead of receipting 10,000 Rand, they receipt 8,000 and deposit 8,000, and they then pocket the rest of the money. And then lastly, there are scams now circulating over the last 2 or 3 years where persons hold out to be property practitioners or estate agents or even the owners of a property investment company. And they typically approach small firms who they feel may be vulnerable or may not have a lot of work, and they appoint such practitioners and propose that they be appointed as their attorney of record and to facilitate transactions by receiving monies on their behalf. What they then typically do is request a practitioner's fidelity fund certificate and copies of their trust or confirmation of their trust bank account and a copy of the practitioner's ID in order to vet them on their system. And once the practitioner provides this information, these fraudsters then utilize the information to scam other individuals. And it's usually involving the sale of houses in various locations at substantially lower prices. And what happens is the unsuspecting purchaser then effects payment into the attorney's trust account. And then the fraudster then contacts the attorney and indicates that monies have been received in their trust account, which they then urgently require to be paid to them. The attorney then views the fraudster as his or her client, and he acts upon their instruction by effecting payment to the fraudster. And the fraudster often offers a cherry in a form of a fee, and he says, okay, you received 500,000 in trust, you keep 15,000 Rand, and you pay me the balance of 485,000 Rand. And then this can go on for numerous transactions, and millions of rands actually gets laundered through an attorney's trust account in this manner. So these are scams that practitioners need to be aware of, and they need to design their systems and processes to withstand such issues and to prevent any form of loss of trust monies. That's all from my side today. I'm now going to hand you over to my colleague, Ms. Margaret Kwakye, who's going to discuss the issues of audit reports and fidelity fund certificates. Thank you.
Thank you, Ashwin. Colleagues, I will start now. I'm just waiting for the presentation to be placed on the screen. Yes. Good afternoon once more, colleagues. My name is Margaret Kwaje. Good afternoon once more, colleagues. My name is Margaret Kwaje. I am the Provincial Director of the Free State Legal Practice Council. As my colleague has said, I will be presenting on Fidelity Fund Certificate and Audit Report Compliance. I see my colleague here.
Can you see the screen?
Yes, we can, Tony. Maybe
Yeah,
just click
we can
on
see the screen.
Okay, thank you.
Click on the presenter, that slide, that token at the bottom, next to the minus sign.
We apologize, colleagues, for that technical glitch.
Bottom right of your screen, Tony, next to the minus sign. If you click on that, it will go into show the slideshow.
Can you see my screen?
Yes, we can.
No, we can't see it, Tony.
Now?
Yeah, it's now on the screen. We can see
Okay.
it, yes.
All right. Apologies for this.
Can you please maximize the screen, Shoni?
Is it big enough?
Colleagues, maybe in the interest of time, should I start with my presentation and then we can come back to this one?
Tony, are you winning?
Yeah, I'm gonna try it again now. But try maximizing it now. Is it big enough yet?
Yeah, we can see it on our side.
Okay. Also, you just tell me where to scroll down. Whether I should scroll down or not. I'm not sure if it's visible for everyone.
What happens if you click on the second screen? I mean, second slide? Oh, okay. Then we can, maybe we can just opt for that system.
Colleagues, we profusely apologize for this technical glitches. We know that your time is very valuable. We do not take it for granted. I will be presenting on Fidelity Fund certificates, as well as audit report and compliance. Now, when I was preparing for this, I thought to myself, as the Legal Practice Council, what challenges is it that we encounter? And not only is it a challenge for us, for legal practitioners not submitting the Fidelity Fund, but we've also realized that in as much as we want to think legal practitioners know what's expected of them or know what's a Fidelity Fund certificate, they don't know what it is. So my presentation is simply going to simplify what it is that is already in the Legal Practice Act. Now, what I want to start off with we must ask ourselves, what is the Fidelity Fund certificate? And what are everyone speaking about when they say, where is your Fidelity Fund certificate? And why is the Legal Practice Council running to court if a member of the profession does not have a Fidelity Fund certificate? The Fidelity Fund certificate is a certificate which enables legal practitioners to hold funds on behalf of their clients. As Ashwin has presented before, legal practitioners are requested to have trust accounts. Now, in order for you to be able to hold funds in that trust account, you must be in possession of a valid Fidelity Fund certificate. The next question we should ask ourselves is, who must be in possession of a Fidelity Fund certificate? Now, that would be an attorney who practices for their own account, either alone or in a partnership or in a juristic entity. So if you decide now I'm going to open my own show, I'm going to run my own business, you must be in possession of a Fidelity Fund certificate. A trust account advocate. The Legal Practice Act, when it came into effect, made it possible for us to have two types of advocate. Now, a trust account advocate must be in possession of a valid Fidelity Fund certificate. This Fidelity Fund certificate, it's not a once-off certificate, colleagues. The validity, therefore, is a period of 1 year. As I've stated before in my opening, that the portal is now open for the 2025 Fidelity Fund certificate. It means you will be obtaining your FFC for 2025, which would be valid from the 1st of January 2025 up until the 31st of December. And it would mean you have to obtain a new one. This certificate does not work retrospectively. You cannot, in the year 2025, still be making use of a Fidelity Fund certificate of the year 2024. Now, when it comes to the Legal Practice Council, the fidelity of the certificate also depends on the council. The council may withdraw a Fidelity Fund certificate when necessary and obtain an interdict against legal practitioners if practitioner fails to comply with the provisions of the Legal Practice Act. Now, a colleague might ask, in what circumstances, because I said when necessary, in what circumstances can this Fidelity Fund certificate be withdrawn by council? Should council receive a complaint of misappropriation, we will withdraw that FFC that was provided to you in the beginning of the year and approach court for alternative remedies. The purpose of the Fidelity Fund certificate, the certificate that we've been speaking about. My colleague Ashwin already touched on the purpose, but I want to emphasize that it enables clients to hold funds belonging to another person. It enables you as a legal practitioner to hold a deposit into the trust account while you are busy doing the service. Let's say you are doing a conveyancing transaction. A client asks you, please help me with a conveyancing matter. You would be holding the price of the purchase price in your trust account while you are busy doing the property transfer. In a divorce or in a criminal matter, you will also be holding a deposit of the monies you've asked while you are conducting the fees. Now, this is what the Fidelity Fund certificate enables you to do. It also enables your clients, whose funds have been stolen from a trust account, from your trust account specifically, to lodge a claim with the Legal Practitioners Fidelity Fund. Now, if you do not have a Fidelity Fund certificate, you place your own clients at the risk of not being able to claim any funds for their loss. The next question we should ask is the requirements to be issued with a Fidelity Fund certificate. What is it that's required? Now, if you practice for your first time on your own, if you are currently a professional assistant or an associate at a law firm, and you decide that you now want to go open your own practice, you must inform the Legal Practice Council and submit a detailed information of where your firm is going to be located, the directors of the firm, the appointment of your auditors, proof of your banking details of your trust account. Then you will be issued with a Fidelity Fund certificate for the first time. However, when you are an existing practitioner that is already practicing for their own account, that is someone that already has an FFC, what is required for you to obtain another FFC for the year 2025? You should have submitted an unqualified trust audit report. I will speak later in my presentation on trust audit report. One of the requirements is that you should have completed practice management training. This is a once-off course that we require legal practitioners to do practice management training in order for them to equip themselves on how to manage their practice. And then you'll also be required to make a payment of the prescribed fee of the Fidelity Fund certificate. Currently, the amount is 395. The consequences of practicing without a valid Fidelity Fund certificate. It is a criminal offense in terms of the Legal Practice Act to practice without a Fidelity Fund certificate. And on conviction, you are liable to a fine or imprisonment. And we know, colleagues, that in order for you to practice as a legal practitioner, you must be fit and proper. A criminal record of such can also taint your chances of still practicing. You are liable to be struck from the roll if you do not have a Fidelity Fund certificate. You are not entitled to fees for the legal services you have rendered. By that, I mean, if you have rendered legal services for the year 2024, let's say from January to March, and you only obtain your Fidelity Fund certificate in April, you are not entitled to those fees from January to March. And the last consequences that you normally see the council doing is approaching court for the suspension of your enrollment pending compliance. So when you comply, you will be able to practice again. But it is a frustration for practitioners to be suspended pending compliance, because it means as the Legal Practice Council, we have to take creatorship, taking ownership of your firm. My next slide is going to speak about the audit report compliance. Now, in terms of the audit report, as I've currently mentioned, you must have submitted an audit report in order to obtain a Fidelity Fund certificate. An attorney or an advocate practicing with a Fidelity Fund certificate must submit an annual audit report to the council. What does this audit report consist of? You might ask yourself. And what is it? So basically, as Mr. Ashwin has indicated, you will have accounting records in your law firm. And this accounting records must be updated monthly or regularly. Now, what you give your auditor, this auditor is a person that you have appointed yourself from your own. You will be providing them with records of the monies you have received and paid on the account. You will be providing them with monies that you have invested in the trust account on other interest-bearing accounts. You'll also be providing them with the interest on the monies that you've invested and paid over to the creditor thereof. The most important question is, when must an audit report be submitted? This audit report must be submitted annually. Now, if you practice for the first time, if you've opened your law firm for the first time, it must be submitted within 6 months, covering the first 4 months of the year of your practice. And when you intend on ceasing to practice, when you no longer want to practice, this audit report is called a closing report. A closing audit report, which we must receive within 3 months from the date that you have notified the Legal Practice Council that you will no longer be practicing. Now, in as much as I said the audit report must be submitted annually, all law firms have a different year end. Majority we see in the Legal Practice Council that their financial year end would be 29 February or the end of February. And as such, it means your audit report must be submitted in August. Tony, can you please go to the appropriate slide? When must an audit report be submitted? Go up, please. Thank you. It means the audit report must have been submitted in August. When your financial year end is in September, your audit report must then be submitted in March. And when your financial year end is in March, your audit report must be submitted in September. So the essence of this is that you must submit your audit report within 6 months from the year end of your financials or for your firm. Failing to submit the audit on time, it will result in your FFC being withdrawn and you being suspended or interdicted. It also has the consequence of you being fined for the late submission. Currently, a fine for late submission amounts to 1,000 Rand. However, we do know that not everyone can afford to submit an audit report. And the Act clearly makes provision for exemption from submitting an audit report. Can you please go to the next slide, Shoni? The next one. Thank you. This exemption is in terms of Rule 54.26. You can apply for exemption if you can prove that no activity has been taking place in your trust account, or the funds in your trust account is not sufficient for you to conduct an audit. However, you have to apply to the council. You will contact your nearest provincial council and they will provide you with the forms to complete for the exemption. You will also be requested to attach your trust account bank statements, and the council will consider whether you can be exempted. Once you are exempted from submitting an audit for the certain period, you will still be eligible to apply for a Fidelity Fund certificate. Next slide, Shoni. Most important of all, colleagues, when it comes to the audit report, what I want to emphasize is that the mere submission of an audit report is not sufficient to be provided with a Fidelity Fund certificate. The audit report must be unqualified and approved by council. We normally receive submissions from legal practitioners to say, I've submitted my audit report. What is the problem? Why don't you allow me to apply for an FFC? The audit report must be unqualified. The moment it's qualified, and we look for the reasons, the basis of the qualification as accordance to your auditor, we are not able to issue you with a Fidelity Fund certificate. The moment your auditor gives any other finding besides that of unqualified, we are not able to provide you with a valid Fidelity Fund certificate. Thank you, colleagues. Once more, if there's questions, you can place it in the Q&A. It will be answered upon. Thank you. Now I give over to Mr. Thomas Harbour.
Good afternoon, colleagues. I'm just going to try and share my screen. Sorry, I don't know. Is my screen, is my presentation up?
Not yet, Thomas.
Not yet, Mr. Harbour. Now
It's up now.
Is it up now?
Yeah, it's
Yes.
up now.
Thank you very much. Yes, thanks, colleagues. Just briefly, I'll just cover the LPWF, what it is and what it does. Also highlight the main risks of areas in legal practice, and then just suggest some, give you some suggestions for mitigating the risk. I'm also just going to turn my camera off in order to save bandwidth. In brief, the LPIIF is a non-life insurance company, what used to be called a short-term insurance company in the old days. It was created by the Fidelity Fund in 1993. We are a non-profit company, and the services that we provide are listed in Section 77 of the Legal Practice Act. Just by the way, the Legal Practice Act was 10 years old this month. And we are currently funded by way of a single premium that's paid annually by the Fidelity Fund on behalf of insured legal practitioners. So those people who like to make comments to us that they pay a lot of money for this insurance, I've got good news for you. You don't pay for it. It's paid for by the Fidelity Fund. We provide three services, essentially. One is professional indemnity insurance to all legal practitioners with Fidelity Fund certificates. So that covers attorneys and advocates practicing with trust accounts. We also provide bonds of security to attorneys who are seeking appointment as executors of deceased estates, and we provide risk management services to the profession. There's some points to note. If there's a practitioner does not have a Fidelity Fund certificate, they will not be covered. And that, if you want to dispute that, please look at Section 77, Section 84(1), and clauses 5 and 6 of the LPIIF policy. You can get the LPIIF policy off our website, and the details are on the last slide. And we were part of litigation that tested whether an attorney is permitted to practice without a Fidelity Fund certificate. And the SCA confirmed that an attorney is not permitted to practice without a Fidelity Fund certificate. Anybody that wants to look at that case, it's NW, as in November Whiskey, Civil Contractors CC versus Anton Romano Incorporated and another. If anybody's interested in the citation, I'll post it in the chat. And also the master policy for professional indemnity as well as the executive to bond policies are on our website. Apologies. Just in terms of the risk management services, just don't know what's going on here with my in terms of our risk management services, we have the prescription alerts service. That's an electronic diary system, and any matter that's got a time limit imposed by legislation or by regulation can be registered with that matter. It's not just RAF matters as some people believe. So whether it's from a personal injury to a general litigation to even a competition law matter can be registered on the site. We also offer risk management training at no cost to legal practitioners and their staff. We'll come to you wherever you are in the country, or we can do it virtually. The details, anybody interested in that, the details are on the last slide. We publish articles in the Risk Alert Bulletin and in the Practice Management column of the Rebus. We also embark on litigation to address liability questions. We either do this in the name of the LPIIF as an entity, or we use the name of the firm involved, and that's by way of the doctrine of subrogation in insurance, that we can step into the shoes of our insured. The most recent matter we've been involved in is this one that I've highlighted on the screen, that judgment from the 20th of March. That's in respect of the RAF Board Notice 271 of 2022. And if anybody wants to know what the status of that matter is, please look at the November Risk Alert Bulletin that you can get on our website. But in short, the RAF has applied for special leave to appeal to the SCA. It was granted this week, so we'll argue that together with the Mautla matter, which is related to the previous board notice. We're also involved in the risk management and insurance module on the PMT program. We also comment on draft legislation that involves issues of compliance or issues of affecting the liability of legal practitioners. Just in brief, these are the claims notified in the last 5 years, and then these are the claims that we've paid. If you look at this graph, you'll be able to see which are the high-risk areas of work. You'll see by far RAF prescription at 42% is the biggest risk. And if we add that with general prescription matters, we're looking at 54% that's paid out. Prescription is a risk that can be mitigated by implementing internal measures. On our website, we have a detailed document on risk management, with also written extensively on how practitioners can mitigate this risk. Conveyancing has been a high-risk area since the end of 2007, the beginning of 2008. And as Ashwin mentioned, a lot of conveyances are being targeted by the business email compromise claims. And so these are just the notifications of cyber claims, because the LPWF, since the 1st of July 2016, cyber crime-related claims have been excluded from the LPWF policy, and people are still notifying them to us. You can see there how these have happened up until the end of September. And colleagues, as we approach Black Friday and the end of the year, cybercrime attacks against law firms and against other businesses and even individuals internationally will increase. So between probably when we update our figures at the end of December, you'll see that there's an uptick in those. Just in terms of numbers, we are now past 260 cybercrime claims that have been notified to us, and which we have excluded based on the provisions of the policy, and past 180 million rands in value. So this should be scary for anybody. I don't want to for today's purposes, I've spoken a lot about prescription and about measures that can be taken in firms to mitigate various risks on various platforms. So in order not to bore people with listening to what I've previously said, I thought that I'll take a different tact for today and just address the issue of managing a law firm and managing the internal relationships. And as you'll see from this slide, the case involving Mr. McKean and Mr. Gaza, sometimes, like any relationship, partnerships in law firms also have breakups, and they are messy and expensive. In this matter, at stake is a claim of $100 million. You would have probably heard about the matter in South Africa involving Mr. Solomon Slom, a former director at Fluxmans, and the 39 million rands he's alleged to have stolen. And then when we look at previous cases, I've just cited this matter, the Chwewu Incorporated matter as an example, because those who are already in partnerships and those who intend to go into partnerships will talk about so-and-so is just a salary director compared to somebody else who's a profit-sharing director. Those are internal matters. They will not assist you when you have a claim or when you're faced with regulatory action from the instituted by the LPC. A director is a director. The Companies Act doesn't make a difference between a salaried and an equity director, and neither does the Legal Practice Act. You can look at the article that I wrote in December last year on that, so please take that into account. And another matter, that's the law matter. If you are in a firm and one person is running the financial side, there could also be risks for you. In this case, in brief, one of the issues there was that the firm's annual income was understated, so that the firm would stay below the BEE threshold, and the LPC took action against the partners in that firm. Some of the partners said they weren't aware of it. The court ruled that the LPC needs to hold a disciplinary inquiry. But I think the point remains that you need to keep an eye on your fellow directors, and don't put your entire professional career in the hands of someone else. And so, having said that, with that brief background, when you enter into a law firm partnership, do you think you have entered into a relationship akin to a marriage, and that those marriage vows will apply to your relationship, and you'll be happy and healthy until death do you part? As you'll note from this article I wrote in 2017, I think not. Try and demonstrate that. One of the measures that firms can consider is, this is just the expression I use, just following on the marriage analogy. Write partnership agreements for divorces, not for marriages. When everything is going well in a partnership and the firm is making money and people are taking huge profit shares and bonuses, nobody cares to look at what the partnership agreement says. And it's the same in a marriage. I don't think couples who are happy refer to their ANCs every Friday afternoon. When the trouble starts, and in many of these claims that we have, the over 2,000 claims that we are currently dealing with, those claims come up either when the relationship has soured in the practice, or the claim itself becomes a trigger for the relationship to sour, and then it starts becomes a game of finger pointing and people blaming each other. So closely study the contractual terms, not just when the financial terms, and amend them if necessary to prevent trouble in future. And again, as Mr. Reddy has mentioned, the issues of death of partners. Ask yourselves what will happen in the unfortunate event of the demise of one of the partners, if somebody is sick or when somebody resigns. You don't want to start fighting about these matters then only. And also ensure that the structure that you use, first of all, is one of those listed in Section 34 of the Legal Practice Act. You can only practice as a sole practitioner, as a partnership, or in an incorporated entity. And then, well, for current purposes, you also have the advocates as well, whether it's trust account or referral advocates. We've seen matters that we've rejected where firms have been advised by auditors and other tax people to form trusts, to hold a partnership, then the trust is a sole shareholder of a PTY Limited, and it's a complicated structure. Those are not authorized by the Act. That's the first place. Secondly, ensure that the description you use is accurate. You get people that use incorporated at the end of the name of the firm. Sometimes, other times they don't. Others use incorporated, but there's no registration number. Please ensure that is consistent. There's a matter that I've written about in an article that will be published in June 2024, where an attorney practicing in the Northern Cape passed away. His surviving spouse, who's the executor of his estate, has argued that be practiced as an incorporated entity and therefore she can appoint a director. The LPC, on the other hand, argued that according to their records, it was a sole proprietorship and therefore it wasn't a separate entity. Please, these are issues that you need to address. And address risk and liability matters in the partnership agreement. If the firm has a claim and an excess has to be payable, how will that excess to be payable? Is it only going to be the partner or the team dealing with the matter responsible who'll have to pay, or are you going to share that loss? And remember that in a partnership, you are jointly and severally liable with the partnership for any of the liabilities. And then if you're running your firm through an incorporated entity, please read section 34(7). It says that all present and past, to summarize, directors are jointly and severally liable with the entity for the debts and liabilities, and then secondly, for any theft committed during their term of office. So if you're in a partnership and you have a partnership that grows long figures and steals monies, you are liable just as much as they are. How you recover money from them is your own problem. Also, what you should look at. Now, when it comes to taking on new partners, we all have referrals. We all can identify people who we think that will make good partners and will bring in lots of work and will all be happy and healthy and will ride off into the sunset. But do thorough background checks on people before they come along. Don't only consider the financial side. Ask, are there any pending matters against the practitioner with the LPC, and check. On that point, there was a matter, South African Legal Practice Council versus Steenkamp and others in the Free State. The judgment was delivered on the 26th of September last year. In that case, the practitioners were suspended in one firm, moved across to another firm that was run by their former professional assistant, and carried on practicing there. They claimed to have been professional assistants in that firm, but the court said that all the documents indicated that they were actually directors. So don't bring people in that are going to come in with liability problems for your regulatory problems. If you're taking on somebody who comes from another firm, check the status of the matters that they are bringing. Have any of the matters prescribed, or is there some other error or omission in the matter that could bring liability to you, so that you can deal with those or not take them out at all? If there are any fees or disbursements owed to the previous firm, that could be a problem, because if the previous firm says that it has a lien over the files, then you can't take them, and in the meantime the clock is running and clients expect service. Check if the practitioner is facing any claims. You can check with the LPWF or ask the practitioner to check to give you some record from the LPWF that they aren't facing any claims. And also, if you have insurance from the top-up market, ensure that you tell your broker that you've taken on a new partner and what it is that they are doing. Your insurer will also be, the top-up insurer will also tell you that maybe you're taking on someone who's got a history of a lot of claims, and the insurer will bring that to your attention. In order to ensure that there are no breaks in cover, tell your insurer about the matters that are coming into your practice, so they can amend the retroactive dates, just effectively the inception dates of policies accordingly. Remember that when it comes to insurance, the duty of utmost good faith, fair days applies. So rather tell your insurance company early. Don't wait for there to be a problem and then decide that at that point to inform your insurance company that will be will be too late. And what else can you do internally to implement a peer review system? Peer review just means that one person, just to have somebody else check your work. And we all make mistakes. You know, there's that saying that even Homer Simpson fluffs his lines. So it's good to have somebody else check. I know people are going to say, but I'm a sole practitioner. I don't have partners. Who checks my work? You could ask if you've got an experienced secretary or an experienced paralegal or even an experienced candidate attorney. They got also good at reading. Have documents, have a documented system of supervision. Supervision is not the same as policing. It's just a matter of keeping an eye on what's happening in the firm. And create a culture where people can immediately report errors or omissions to you so that action can be taken. If it's something that needs to be reported to the LPIF early, report it early. There are some matters that we get involved in early, and we can find a way to ensure that the claim goes away. It may be something that we can bring an application for to rectify, or even a rescission application if a default judgment has slipped through the cracks. Conducting regular file audits. This is not the same as financial audits. It's good practice that at least once a year to look through all the files in your firm to see that everything is being done as it should and when it should be done. You don't have to do it at one sitting. You can split it up, do it every quarter, but just ensure that things are being done and that you don't take people's word for it. And importantly, it will help you see whether there's another practice being conducted within your practice. One of the most common points that's raised with us when a claim is notified is that the partner will say, I was never aware of this file, wasn't even aware of that we had such an instruction until the person that was dealing with it left. Also get a lot of stories about files that were hidden under cupboards and the like. So if you conduct regular file audits, you can check that. And then if you have problem files, close them when necessary. And tell clients if you don't have the appetite to deal with it, to deal with the matter, if you don't have the resources, inform the client and tell them to go and see another attorney. But if there's a claim is going to prescribe in January and you would have informed them now in November, tell them and put it in writing and say, go and see another attorney because your claim prescribes in January. We have a lot of claims where an attorney is sued and the attorney said, but I advise the client to go and see someone else. And the client says, no, I do know nothing about that. I kept phoning and nobody was giving me updates on the matter. So please do that. And if you put it in writing, it's better for you. It will help you and assist the client in the event of disputes. And Ashwin also touched on the segregation of duties in the financial function. But it's really risky to have one person doing everything. We've had several matters that reported to us where the attorneys say that I trusted the bookkeeper or I trusted my fellow partners, and that person would have carte blanche to requisition payments, authorize the payment, and then even release the funds from the bank account. When staff or your fellow partners bring you payments to authorize, please look at them and make sure that the documents actually relate to that payment. One of the examples I often give in the PMT course is a matter from Cape Town. There were 4 partners, and one of them was responsible for the estates department. The staff internally started running a scheme where they take money from people outside. So somebody owed money to the city of Cape Town. They would give their account to the people in this firm. and those would slip it in with the estate files, and they'd go target one partner who they said was not particularly diligent at looking at documents. So when the other partners were out, they'd approach him, and he'd just look and say, "Oh, estate, City of Cape Town," and he'd authorize the payment. They found out later that when they had more than 600,000 rands was paid. It's the same with the debt collection for the firms. A lot of times, the people doing the debt collection make arrangements when debtors want to pay. They'll say, "We'll send you the account details." Instead of sending the firm's account details, they send their own. In respect of cybercrime in particular, and you'll see from the information on our website, I've written about this a lot. Have a verification system that's prescribed by Rule 5413. That rule says that before you make a payment, verify the payment instruction and also verify the banking details. If we just did that, we would significantly reduce the amount of cybercrime. When you are given a version or an explanation, apply what the auditors call professional skepticism. Don't just accept things. There's that old saying, and that to trust is good, but not to trust is very good. And asking questions is not implying that somebody is a liar. Ensure that people in your financial team take leave regularly. Be careful, and I know I've said this, some of you have probably heard me say it many times. Be careful of people in the financial team who never take leave, who never get sick, who you can phone on a Friday night and ask them on Friday, today, the 8th of November, you phone them at 10 o'clock at night if you're still working. They'll be able to give you an explanation for a transaction that happened on the 13th of June. The reason they don't take leave is to cover their tracks. The reason they stick they make sure that they're always close to the action is to also ensure that the narrative that they push applies. And then when people leave your firm, or people move around within teams, if you have a bigger firm, have a formal system for the handover of files. Don't let people just grab their bags and leave. Have a formal system so you can go through the files and see what they've been working on, what needs to be done, what has been done, what's outstanding. Are there any outstanding fees we need to recover? Because we also see that as a huge problem. And then these are just, if you need to contact us, those are some of the, those are our contact details. But just a few other points before I go. We also challenge the 2-year prescription period for the RAF regulations. That's for hit and run claims, where the claimant was under a legal impediment. That judgment came out in 2019, but I see that a lot of practitioners are either unaware of it or are ignoring it. If anyone wants the citation of that, I'll put it in the chat. And then remember that once risks materialize in a firm, that will either be a trigger for the breakup of a firm, for attrition of staff or clients. Once there's litigation against your firm, litigation in South Africa is public. And bad news travels fast. One of the things we are good at it as lawyers, I'm also a lawyer, is gossiping, and that damages your reputation. Remember, as Edwin said, trust account, the internal controls in terms of Rule 54.14.7, and FICA. I'll also, if anybody's interested, I'll also paste a link to a recent appeal in the matter of Kunene Rampala Incorporated versus the FIC the firm there was hit with a fine of 7.7 million rands. In respect of cybercrime, I've sit with a library that goes back to 2011. The 15th of December 2011 is the earliest judgment I have. The latest judgment I have was delivered on the 5th of November in the Western Cape. Cybercrime is rife, colleagues. And just if we all have an obligation to report unethical conduct of our colleagues. That I covered in an article in Dairevusi in 2023. So don't hide things. And then just lastly, this is my parting shot, is training. It's very, very important that a firm has a training program. I know people will say that it's expensive and time consuming. That organization lead does training on a variety of subjects. The LPWI provides training free of charge. I conducted the module 2 of PMT. It's really said the state of the scripts that are many of the scripts that are submitted there. I don't know whether there's a big gap between university and practice. I don't know whether there's some firms don't have proper training programs. But colleagues, please, you have an obligation. If you take on candidate attorneys, you have an obligation to ensure that they are properly trained. And if you can't do it yourself, there are various options to have that done. And then secondly, none of us know everything. So we all of us every day need to hone our skills and to receive training. Thank you. Sorry I've taken up so much of your time. And that's the end of my presentation.
Greeting colleagues, just before we close, I think we promised that towards the end of the session, we will just read out a few questions and ask the presenters to respond. I'm told that they've responded to a number of questions that you've posted, but I see few here. If they've responded, then that's good. If they haven't, then we are going to provide them with a chance to do so. So I'll just read out a few here. We've been receiving questions about the slides, whether they will be available. The answer to that question is yes. I think as from next week, we'll try and make sure that you do receive them. But right from the beginning of this session, our director did mention that some of these will be available from our own YouTube sessions. So yeah, one of the questions that I can see here comes from Lindy. Lindy wanna know as to what IT systems and software do we recommend to utilize for risk assessment and internal controls? I'm not too sure. Ashwin, are you able to respond to that?
Temikos, so we don't actually provide any recommendations pertaining to software and service providers. That's incumbent on the practitioner to do their research and find a solution that works for them. There's various factors that go into it in terms of cost and things like that. So what works for one firm may not work for another, unfortunately.
Okay, thank you so much, Ashwin. Then there is another question which comes again from Lindy. She want to know as to how best can a small law firm manage cybersecurity, especially those without a physical server in the office and that use cloud as a server.
Okay,
so if I could take that one, if I could, sorry, Ashwin, if I could take that one.
Yes,
on our
please.
website, in the risk alert bulletin, we've covered this and made numerous suggestions. Also referred to the judgments on this issue, and as well as to other writings that make practical suggestions. So I'll ask if the colleague could please look there. I know we've covered it extensively in the practice management column of Dareios as well.
Okay.
So yes.
Okay, thank you, Thomas. If I may ask, here's another one. Do we have a risk policy standard template for one man to small law firm to use as a guide to customize one's own? Thomas?
Yes, there's one. Well, there's one on our website on the risk on the risk management page of our website. There's a document there that people can customize. Quite comprehensive, and it's generic. It can be, people cannot beat it.
Okay, thank you. This one, this person want to know as to how one can rectify an erroneous transfer into their trust account.
I mean, Kosi, I can address that issue.
Yes, Ashwin, please.
So firstly, the practitioner would need to clarify and investigate the source of the monies being incorrectly paid into his trust account, whether it's a payment from an outside source, or if it's a payment from a client. If it's from someone that he's uncertain about and monies were just paid into his account and there's a request from someone to pay it out, he must just be cautious of those type of deposit scams. But if he's aware of monies that were paid into his trust account and he's aware of the source of it and he's confident of it, he can either then refund the monies directly from the trust account, or if it's monies that were incorrectly transferred from his business to trust, he can simply transfer the monies back into his business account.
Okay, thank you so much, Ashwin.
Sorry,
yes,
yes,
Thomas, you can come in.
Just to come in there with Ashwin's question, to add to what Ashwin said. We were involved in a matter many years ago, Herschelwitz Fleonis versus Bartlett, where that exactly happened. So please ask colleagues to please read that, because that was the exact modus operandi in that Herschelwitz Fleonis and another versus Bartlett is the case. Look at the SCA decision, please, not the decision in the Johannesburg High Court.
Okay, thank you, Thomas. Here's another one. Can you withdraw FFC if attorneys fail to pay their correspondents or advocates?
Thank you, Nkosi. That would not be a basis for the council to withdraw a fidelity fund certificate. However, as a legal practitioner, we do expect a level of professionalism in that when you have utilized your colleagues as a correspondent or an advocate to honor the fee agreement, your fidelity fund certificate will not be withdrawn, but if your colleague does lay a complaint against you with the Legal Practice Council, you can face a disciplinary hearing. Thank you.
Thank you so much, Maggie. I think this is a comment. It read thus: no mention was made on the payment in interest accrued on trust accounts and the requirement to pay these monthly. Can we say something?
Can you just repeat the question?
Read it again. Okay. This one says no mention was made on the payment. I think there was no mention of this while we were running the presentations. No mention was made on the payment in interest accrued on trust accounts and the requirement to pay these monthly.
Okay, I can address that. I've responded in the Q&A section, but I'll repeat it here for the benefit of everyone. So the interest on your Section 86(2) trust accounts needs to be paid over to the RPFF on a monthly basis. The interest that accrues on balances held in your Section 83 accounts is to be paid over to the LPFF annually or before the last day of May each year. And in respect of the 5% interest, which is payable to the LPFF in respect of your Section 86(4) trust investment accounts, the interest is to be paid over to the LPFF on or before the last day of the last it's on or before the last day of the next succeeding calendar month. So it's before the end of the next month, basically. And that's contained in Rule 54.14.16.1.
Thank you so much, Ashwin. And this is a very interesting one. Please clarify for a small firm that does not yet hold funds of a client. Also clarify where small money such as opening a file goes to the trust.
So if the monies or the fee has already been earned by the practitioner, so if he's already opened the file and he's done the work, then the fee is due and payable to the practice, and in such instance, it can be paid directly into the business account. There wouldn't be a need for the monies to first be received in trust.
Okay, thanks, Ashwin. We have just have few questions left. Is an exemption to submit an audit report for those practitioners who are not submitting for the first time, or even new firms can apply for exemption?
So anyone can apply for an exemption, whether it's an opening audit, annual audit, or closing audit. You can even apply for an exemption applications 10 years in a row. The exemption is merely in circumstances where your trust account is dormant or relatively dormant, and the criteria that's typically applied internally within the LPC is that you've got amounts flowing through the trust account of less than 100,000 Rand in that particular financial year, or there are less than 3 transactions per month.
Okay, thank you. Thank you, Ashwin. Here's another one. How do I know if the audit was approved by the council?
Thank you, Tebinkosi. Please contact your provincial council. You will receive it in writing confirmation from them, or whether the the exemption has been approved or not. If the exemption is not approved, you'll also be informed. However, if you've not received any feedback since submission, please contact your provincial council. They will inform you. This is also concerning the audit report. When you go to the Fidelity Fund portal, when you are able to apply for your FFC, the audit would be approved. If not, please contact your provincial council.
Thank you, Maggie. I think this one is directed to you, Thomas. The question is, should you not approach your own PI insurance before you can claim from the LPIF?
Thanks, Mr. Ngoba. That's an important question. You claim from the LPIF first, because the LPIF is the primary insurer that they call, or the base layer. Your own PI insurance is top up, it sits on top only if the claim is not covered by the LPIF or it exceeds the available cover, well, the top up do it. But just as in order to be prudent, it's good to notify the claim at the same time to both your top up insurer and the LPIF simultaneously, and then the two insurers will work together. Thanks.
Thank you, Thomas. Yeah, here's another very important one. Does an attorney enrolled in 1994 still required to complete a practice management course to apply for their FFC?
Thank you, Tembinkosi. Yes, if this attorney never practiced on his own account before, or meaning as a director in a law firm, he is required to do practice management training, because this practice management training is equipping you on how to manage your practice, the risk involved in all of those things. However, if this practitioner that was enrolled in 1994 was working in partnership with other legal practitioners in a law firm and then decides to open his own, it is not required for them to do practice management training. Thank you.
Thank you, Maggie. Is there a mandatory limit for one to apply for exemption to submit audit report?
Temingos, I think we've already answered the question previously, but to reiterate it, it's basically less than 100,000 Rand in a particular financial year.
Okay, thank you. Ladies and gentlemen, I think due to time constraint, we are unable to read out all the questions, but you will be provided with the slides as well as the recordings of this session. Thank you so much. Maggie, back to you. Thank you.
Thank you, colleagues, for availing yourself to attend to this presentation, the webinar hosted by the Legal Practice Council. We look forward to holding more of these webinars. And like I suggested and stated earlier in the presentation, you are welcome to send us an email at info@lpc.org.za with suggestions on what else we can present to you as the legal profession. Thank you, colleagues. Hereby, I close the webinar.